every limited company must prepare accounts and a corporation tax return. But who are you preparing those accounts for? Well, firstly, for the shareholders of the company. The owners need to know what the profit and loss has been and what assets the company has. Secondly, for HMRC, how will they know what tax you need to pay if they haven't seen a set of accounts? And then also for Companies House, the government body that looks after all companies. And the accounts that go to Companies House are actually publicly available for anyone to download and look at. Well, the statutory accounts include a balance sheet, which effectively states the assets and liabilities of the company. There's a profit and loss account showing the sales, the expenses, and summarising it down to a profit or a loss. A director's report, which is a short statement by the directors on how the business is going, and then an auditor's report, where an independent body, an auditor, actually certifies that those accounts are broadly correct. Now, you may be able to file abridged accounts. These abridged accounts would only have the balance sheet, profit and loss and director's report. You don't need an audit. And to be able to do this, you need to fulfil 2 out of these following 3 criteria. Your sales must be less than £10.2 million in the year. You must have less than £5.1 million of assets and less than 50 staff. And that, like I say, does cut down on the admin and what you need to file. If you are a smaller business, you can actually file micro entity accounts. To do this, again, there's 2 out of 3 criteria you have to hit. Your sales need to be less than £632,000, assets less than £316,000 and less than 10 staff. In this instance, your balance sheet is abbreviated even more so. And with both the abridged accounts and the microentity accounts, you only file the balance sheet to Companies House, i.e. the general public can only download your balance sheet. They can't see your sales for the year or your expenses for the year. So as well as the admin side, there are some privacy benefits of filing the smaller accounts. But in your first year of trading, you trade for a year, and then your deadline will be 21 months after your date of incorporation. After that, each year your year end passes and you get 9 months after the year end to file your accounts with Companies House and HMRC. So as an example, let's say you incorporate your business on the 1st of January 2018. You trade for a year, and then actually your year end will be the 31st of January 2019, because the default is that the Companies House always give you the last day of the month. But the deadline to file will be on the 1st of October 2019, i.e. 21 months after the date you set the company up. The following year, your next year end will be on the 31st of January 2010, but then you do get the 9 months to 31st of October 2010 to file those accounts and the tax return. And that will carry on for every year after that. What happens if you're late? Well, there are fines. You're fined £150 by Companies House if you're late. And broadly, the fines increase every 3 months after that. And that fine does get up to £1,500 if you're more than 6 months late. So my obvious advice is get them in on time. To an extent, the earlier the better. You don't have to wait until 9 months after the year end. If you can do them early, file them. And in terms of the tax, you know what tax you've got to pay. You still don't pay it till 9 months after the year end, but you know what it is. And if need be, you've got time to save for it.